Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's September 6th. We got a lot to go over, so we're going to kind of just jump right into it here. We'll start off with the ADP employment because it's such a short week. It moved from Wednesday's reporting to today, and last reporting in July, we had 217,000 new jobs in the private sector. Today came in a little disappointing at 163,000. They were kind of expecting about 185 to 200,000, but it came in at 163,000. Now tomorrow we get the big one. This is by the Bureau of Labor Statistics, or we also for short BLS. That'll be coming in tomorrow. Now, if you recall, a couple of weeks ago we had the sample week for unemployment or the unemployment filings, the week the jobless claims. It came in really low, and so that's why we kind of think tomorrow could be a pretty strong number there. Now, it could be because what we're seeing is the market is getting really tight. As you see, even here at 213,000 the previous week, 13,000 people applying for unemployment. Forecast supposed to be in the same range, and it dipped even lower at 203,000. This is the lowest number we've actually seen since the summer of 1969. This is a long time since we're at historic lows in terms of people applying for unemployment. And the job numbers are just really kind of a telling tale of the job market, where we got jobs available, but we don't have enough people to fill it. So that's why I'm starting to think that maybe this number here may come in. Even though it's disappointing, we just don't have the supply there to meet the demand that's out there. And so let's kind of watch that going forward here. It's kind of like the appreciation levels. We're seeing the appreciation levels shrinking a little bit. Even though home prices aren't going down, they're still going up. And it's kind of in the same line. We just don't have enough people that are out there looking for jobs to fill the vacancies out there. So let's kind of move on here. We got the productivity for the second quarter, and the initial one came in at 2.9%. They thought it would have a slight uptick to 3%, and it remained at 2.9%. However, the unit labor costs, initial one came in at 0.9%, and the forecast is supposed to be a drop of 1%, and it did drop it at 1%. So labor costs came down a little bit in the second quarter, which can be good news in the sense that it could be inflationary, which could show keeping inflation in check. But tomorrow we'll get a better gauge when we see if there'll be any wage inflation coming in. That'll be something that we'll really watch if people are making a lot more money, if we're getting a bit of a spike in that or not. Now, we also got the services industries. Next two indexes are in the service industry. And July's reporting for the market service PMI is kind of mixed here. As you can see here, we had a 56 in July, and it dropped to 54.8 in August. But however, the ISM non-manufacturer, also the service industry, jumped from 55.7 in July to 58.5 in August. So kind of mixed report there on the services industry here. Last but not least, we got the factory orders for the month of July. So in June, we had an uptick of increase of 0.7%. However, in July, the forecast is supposed to be a drop of 0.6%, and it dropped a little bit further down to 0.8% in July here. So let's check out the headline news. Stock market is down. The tech sector is kind of taking its cue again. It's been outperforming, Nasdaq's been outperforming the other indexes, and a lot of it has to do with the FANG, the high end like Alphabet, Facebook, all those guys. The big ones are kind of leading the charge, and now they're the ones that are kind of bringing it down, so to speak. A lot of it looks like there's really no rhyme or reason for it. It looks to be more a profit taking, and perhaps a correction could be on the horizon here. So we'll have to kind of see the next few days as to how if it trades or not in the negative still. All right, and then yesterday we had resuming of the talks with Canada, and they continue. They still haven't struck any accord or kind of made any deal, so they're still kind of talking their way through it, and hopefully we'll have resolved. It is important primarily because 30 of the states in the Union, the primary trade partner is with Canada, so we would like to obviously have some resolve with that. And last but not least, there's been still more talk about the more tariffs on China. Matter of fact, $200 billion worth of goods that could be brought up here, and that could be done as soon as this week here. Again, there hasn't been any new light of day on anything with China yet, and with another additional 200 billion could be on the horizon. Now, the thing about that is, if I recall, it'll be hard for China to reciprocate that because the trade gap is so large that they may not be able to have enough to really to offset that. So it'll be interesting to see how they play out when we kind of, more of their goods that would affect them more. But of course, we're trying to target these as in a sense that it's not going to affect American business as much. So, but it'll be interesting to see how this again all plays out in the future here. So let's kind of move along here, see how this is affecting the bond market. Bond market is up about 14 basis currently. We're just above these, which was a ceiling of resistance. So we'll have to see if we can continue a break above this and use that, let that become a floor of support. As you can see here, we're becoming in an oversold position here. We're starting to reach this line here. We're not there yet, but we're starting to approach that. So we have more room to go before we may have to see a trend or anything go the opposite direction. But right now, we're having a nice little day here. Again, this could change tomorrow if we have a strong jobs number, and especially if it has a strong high wage, anything that could, due to wage inflation, that could hurt the bond market tomorrow. So be very cautious. But right now, we do got at least 1 day of reprieve for interest rates. So if you're out there floating, may want to consider maybe locking in today in ahead of the jobs report. That could help drive the markets a little bit further, especially any talk with the trade between China as well as Canada could move the markets as well. So here's the 10-year Treasury. As you can see here, it's breaking below these. We're down to about 2.87 now, down from the 2.9 level we were at earlier, breaking below those levels, and now those could become potentially a floor or a ceiling of resistance for them. So let's wrap this up, and if you guys want to get more data, just come over to Twitter. You can see me posting throughout the day on there, any market change that might affect the market. I'm at Mike Bjork on Twitter. Otherwise, enjoy the rest of your day. We'll see you guys tomorrow. Thanks for watching. Bye-bye.